Welcome back to the Financial Stuff I Wish I Knew video series. I have an urgent update for you. Now, this is something I very much wish I had known when I was younger. This could have made such a huge difference. We will first discuss how to become eligible for Social Security retirement benefits. Next, we will discuss how your Social Security benefits will be calculated. This is most important. You won't want to miss this. Then, we will go over some additional information and commentary. We will finish up with how to protect yourself from the Social Security benefits shortfall. Now, let's dive in. To become eligible for benefits, in the words of the Social Security Administration, you must become fully insured. To become fully insured, you must earn a total of 40 credits. You can only earn a maximum of 4 credits per year. Because of this, it will take at least 10 years to earn 40 credits. For 2025, every $1,810 you earn working will earn for you 1 credit. This dollar amount increases each year as average wages increase. Now, for the most important part, how your Social Security benefits are calculated. While it can take 10 years of work to become eligible for Social Security retirement, as of 2025, the calculation of your benefits is always based on 35 years. For example, if you work for 37 years, the Social Security Administration will use the highest 35 years to calculate your earnings. However, if you work less than 35 years, the Social Security Administration will consider zeros for the years less than 35. For example, if you work for 30 years, zeros will be entered for the missing 5 years when your retirement benefit is calculated. The Social Security Administration uses a complex method to calculate this, called AIME, which means Average Indexed Monthly Earnings. For our examples today, we will use simple averages to demonstrate how your retirement earnings can be negatively impacted by this. Let us look at these examples. First, sample 1 is showing 5 counted 5 times. To calculate the average, we add the values up and then divide by the count of numbers. In this example, the average is 5. In sample 2, we add 3 plus 4 plus 5 plus 3 plus 4. This equals 19. Finally, we divide by the count of numbers, which is 5. 19 divided by 5 equals 3.8. In sample 3, we have 5 plus 5 plus 5 plus 0 plus 0, which equals 15. 15 divided by 5 is 3. Now, let's consider these numbers as income. Look at samples 4 and 5 and notice the income levels in the average fields. Now, look at sample 6 where there are zeros for a couple years. This situation results in a significantly reduced calculation of your retirement benefits. Now, let's take a look at benefits in retirement. Take a look at this table. Look at the area circled in red. Look at the bottom of this section. Notice the line for people retiring in 2025. If someone has an AIME of $11,017 per month, their actual retirement benefit will be $4,043 per month. This $4,000 is approximately 36.7% of their average indexed monthly earnings. In simplified terms, if your average earnings are $50,000 per year when you retire, you can count on more than a 60% income reduction. For example, you could go from $50,000 to less than $20,000. Now, let us discuss some additional information and commentary. The Social Security Administration does not consider passive income from things such as interest, dividends, rental income, etc., as working earned income. These income sources are not factored into your retirement benefits calculation. However, if you are or plan to earn income from rental properties, for example, it is highly recommended that you meet with a certified financial professional. It is likely that you could form the proper corporate entity and make yourself an employee of such entity to which you receive a salary from. In this way, it's possible that this income can be included as part of your benefits calculation for retirement. Remember to discuss these things with your certified tax professional or consultant. Be sure the correct taxes are being paid on this income. For the self-employed or persons with side businesses, The calculation for your Social Security retirement benefits are made from your net profits, not your gross profits. It is recommended to meet with a CPA to help ensure you are balancing tax efficiency with ensuring maximum future retirement benefits. It should be noted that CPA fees and other professional services are usually tax-deductible. Again, you should consult with your tax or accounting professional. Many believe that Social Security won't be there when they retire, that it will be bankrupt, that it will be gone. This is a misnomer, in my opinion. Social Security is simply one of the few federal programs that pays for itself. Social Security is paid for by a specific tax that comes out of everyone's paycheck. This is called the FICA tax. It is sometimes called OASDI, which means Old Age Survivors and Disability Insurance. It is true that in the coming years, Social Security will become insolvent, meaning the money coming in will be less than the money going out. In my opinion, Social Security will not simply disappear as many would like you to believe. It is my opinion. This is political fear-mongering by both political parties. It is my belief a combination of things will happen when Social Security becomes insolvent. Benefits could be reduced for future retirees. Borrowing to pay for benefits is likely, as the United States already borrows trillions of dollars for other federal programs such as the military, housing, disaster relief, infrastructure, etc. In any case, we cannot count on Social Security to completely replace our income when we retire. The government is not going to make up for whatever the shortfall may be. Therefore, it is up to each and every one of us to plan for our own retirement. It is imperative that we begin as young as possible, as soon as possible. These next 4 slides are examples to illustrate how saving for your retirement can pay off for your future. Each chart is a 9.5-year backtest using PortfolioVisualizer.com using ticker symbol SCHD, which is the Charles Schwab Dividend ETF. This chart is based on saving $200 per month in an IRA, employer-sponsored 401k or similar. The black line represents the total amount you have personally contributed. The green line represents the total worth. As you can see, over time the value outpaces your contributions. This is your money working for you, as opposed to you working for money. This chart assumes that dividends are reinvested. This next chart is showing your income over the same period of time, and assuming that dividends are reinvested. The next 2 charts are assuming you are contributing the maximum allowed into an IRA, which was $5,500 per year, or approximately $458 per month. In recent years, due to inflation, the United States began increasing the maximum allowed contributions so that future retirees can increase their contributions over time in consideration of inflation. For 2025, the maximum IRA contribution is $7,000. Persons over the age of 50 can contribute an additional $1,000. For employer-sponsored 401k accounts in 2025, the maximum allowed employee contribution is $23,500. This figure is increased each year considering inflation. Do not allow yourself to be left behind. There is no time like the present to get started. Your future self depends on it. Remember, you can create an account on the Social Security website and view your account. Before retirement, creating a My Social Security account allows you to view your personalized retirement, disability, and survivor benefit estimates, etc. Remember to trust certified professionals more than AI avatars and social media influencers. Contact the pros. Thank you for listening and take care of yourself.